We've got a massive week lined up with the FOMC meeting on deck, and I'm going to show you how you can take advantage of it with my top 3 options plays for this week. I'm going to share with you the exact setups I'm watching, where I'm looking to enter, and how you can maximize the return on your capital while safely managing risk. So by the end of this video, you'll have a clear game plan that you can actually use with no guesswork. Hi, my name's Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you're someone who wants to build consistent income, retire early, and take control of your financial future, make sure to hit that like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or simply looking to fast track your learning and avoid costly mistakes, click on the first link in the description below for one-on-one coaching with me or to join my Discord community, The Launchpad. Inside the Launchpad, you'll get weekly trade alerts, learn how to open, roll, and master risk management, and even have direct access to me for any questions or guidance. Now, a quick disclaimer before we get started that this video is for informational and educational purposes only and should not be considered financial advice. I'm simply showing you my trades and how I trade, and I'm not a licensed financial advisor. With that said, let's jump in and get started. If you look at the S&P 500, it started November on the bearish note, coming down all the way from 68.78 to 65.43, an over 300 point drop and almost a 5% drawdown in about 20 days. But once it got to its 100-day moving average, which is this 65.35 level here, it highly respected that level and made a strong reversal, going up 7 days in a row. Since then, it has been range bound and has been consolidated in between the 6900 and the 6800 level. I'm recording this video on Monday, December the 8th, and SPX is down 0.46% as we speak, down slightly for the day. However, if you look at the RSI, which is the relative strength index, the RSI is close to 57, meaning that we still have more buyers than sellers in the market. And anytime RSI is over 50 for a stock, that is considered a bullish sign. Also, if you look at the MACD indicator that we have right here, we had a bullish crossover that actually began here around November 28th. And the MACD shows us that we're still in a bullish state, even with a slight pullback today. So looking at the economic calendar, the only major event we have before the FOMC meeting on Wednesday is the job openings report, which is scheduled for release tomorrow at 10 a.m. I'm not sure if the job openings report is actually going to cause a big deviation to the Fed's decision, but nonetheless, it is an important indicator right before the FOMC report. Now, the FOMC interest rate decision is scheduled to come out on Wednesday, December the 10th at 2 p.m. Eastern Time, and we'll see how that goes. If you look at the CME FedWatch tool, we still have almost a 90% chance of an interest rate heading into the FOMC meeting. So although I do believe that we'll end up getting an interest rate cut as expected, there is a strong possibility that the markets might end up selling that news and we may see a potential drawdown over the next few days. So while we may see some short-term volatility over the next few days, my long-term outlook for the S&P 500 is bullish heading into next year. Now, with that said, let's jump into my first pick, which is actually one of my favorite stocks to trade, and it's none other than Robinhood, ticker symbol HOOD. Now, Robinhood is one of those companies that has changed tremendously since its IPO, turning into a profitable platform with continuous improvements and product launches over the past few years. It operates with a 50% profit margin, and just this morning, Robinhood announced plans to enter Indonesia with a brokerage and crypto trader acquisition. Let's check it out. So Robinhood will acquire Indonesian brokerage firm Buena Capital Securitas and licensed digital asset trader Pedagang Asset Crypto, making the retail trading platform's entry into Southeast Asia's major crypto hubs. Now, Indonesia is among the world's leading adopters of cryptocurrency, backed by supportive regulation and a tech-savvy young population, making it a prime target for the US firm seeking growth into Asia. The country has more than 19 million capital market investors and 17 million cryptocurrency traders, underscoring its appeal for both stock and digital asset trading. So while Robinhood did not disclose the financial terms of the deal, it is expected to close in early 2026. Now, with that news, Robinhood popped up 3.3% even with the rest of the market being in a downtrend today. So looking at Robinhood's 6-month chart, it's trading right in between the top and the middle of the Bollinger Band. If you look at the MACD indicator, it is also showing that we had a bullish crossover just last week and it continues to be in a bullish state right now. If you look at the RSI, the relative strength index, we also see that the RSI is 57. And again, anytime the RSI is over 50, it means that there's more buyers than sellers. So keeping all of those indicators in mind, And looking at where Robinhood's trading right now, the first level of support that I see for Robinhood is at this 123 level. Now, this is the middle of the Bollinger Band, but considering that Robinhood's trading around 136, it's very close to the current price. So I'd like to be a bit safer, especially keeping in mind that we have the FOMC meeting this week. And in case the market decides to sell the news, that would be a perfect opportunity to sell some cash secured puts on Robinhood. So again, going back to some support levels, the 123 level, which is the middle of the Bollinger Band, is pretty close to the current price. So I'd like to be a little safer. And if you look at the bottom of the Bollinger Band right here, that is around the $105 level, which is probably a bit too far from the current price. So I'd like to settle for a price in between the middle and the bottom of the Bollinger Band. And if we see right in between the middle and the bottom of the Bollinger Band, we have this 115, 116 strike price. So let's pull up the options chain. And in this case, I'm going to go out to the January 9, 2026 options chain, which is about 32 days out. As I mentioned, I would like to pick a price in between the middle and the bottom of the Bollinger Band. We said the 116 strike price was actually right in between the middle and the bottom of the Bollinger Band. So if we check out the 116 strike price, this is a delta of 17. And if you see right here, going with this strike price would offer you a 2.3% return on your capital. So if you'd like to be super safe, the 116 strike price is not bad and gives you a 2.3% return on your capital. Now, as for me, I'm really bullish on Robinhood. I love the stock and I wouldn't mind going a little higher. In fact, I like this 120 strike price right here. Going with the 120 strike price, I would collect a premium of $355, which is $355, which is simply taking the $3.55 and multiplying it by 100 because the one options contract represents 100 shares. Now, the 120 strike price is a delta of 22, meaning that there's a 22% chance of Robinhood getting to this stock price by our expiration date. If you also look at the return on capital, this would offer us a 3.07% return on capital. So that's exactly what I generally like to target. My next pick is Meta, and Meta is actually one of those companies that I've had a close eye on ever since Meta reported its earnings back in October. Now, as you can see right here on October 30th, when Meta reported its Q3 earnings, the stock tumbled 20%, going all the way from $750 to $680. Now, if we take a close look and see what happened, one of the primary reasons for the drawdown was increased AI spending, which is basically increased capex. The main concern for investors was the management's forecast was substantially higher for capex in 2025 and 2026 to build AI data centers and securing computing assets, with Meta projecting 2025 capex to be between 70 billion and 72 billion and even higher in 2026. Investors were spooked that these ballooning costs would compress profit margins, especially given the past heavy spending on the metaverse project, which didn't really pan out as expected. Another reason for the large drawdown was a one-time tax charge, and because of that tax charge, Meta reported an 83% drop in its earnings per share. Again, this was a non-cash 15.93 billion tax charge resulting from legislative changes. So while this was a one-off accounting event that did not affect the company's core performance, the headline was enough to rattle the investors and ended up causing a large drawdown. Last but not least, unlike peers such as Google and Microsoft, which have cloud businesses to sell AI capacity to others, Meta's AI spending is for its internal use. Investors are uncertain how the massive AI investments will translate directly into future revenue and are wary of diminishing returns on the spend. So as you can see right here, looking at the 6-month chart, this is right after the earnings, and the stock continued to fall until it finally found footing at this $580, $581 level. And as you can see, it started consolidating at the 581 level. And as the rest of the market came back up over the past week or so, Meta followed, coming back up all the way to $645. And then right after that, this past Thursday, Meta jumped all the way from $645 to $673 on the news that Meta was making spending cuts to its metaverse project. Let's take a look. So Meta shares popped 3.4% this past Thursday, despite a mere 0.22% increase in the Nasdaq Composite on that day, on the news that the company was cutting metaverse spending in favor of AI and smart glasses. Now, if you look at some background in the metaverse project, Facebook changed its name in 2021 to Meta Platforms to better capture the company's expansion beyond its flagship social media product, Facebook. So while the name change was taken positively, it resulted in a sharp decline in Meta stock, falling 64% in 2022 compared to a 33% decrease in the Nasdaq. The sell-off was due to a decline in Meta's family of apps, operating income and losses on metaverse, augmented reality, and virtual reality spending, which is under the company's research and labs division called Reality Labs. So while Meta's losses at the Reality Labs have continued to increase, its family of apps, namely Facebook, Instagram, WhatsApp, and Messenger, has been the saving grace, as the income from those family of apps was more than enough to offset the losses at the Reality Labs. So if you look at this chart right here, the purple line indicates the revenue. And if you look at Meta's revenue going all the way from 2016 to 2024, it is in a continuous uptrend going all the way to 189 billion. So if you look at the blue line right here, this is the operating margin. And as you can see, it did take a nosedive back here in 2022, but due to Meta's overall financial performance, it came back up, and Meta still operating at a net profit margin of 43%. So again, that proves that Meta continues to be a strong organization with decent profit margins. And in my opinion, a one-time tax charge is not enough to change the overall fundamentals of the company and its strong financial performance. So let's jump back and check out Meta's 6-month chart. As you can see right here, Meta's trading at the top of its Bollinger Band at the $675 level. We also have a bullish crossover that began last week. And if you look at the RSI, its RSI is 61, meaning that it's solidly bullish at the moment. So keeping in mind that Meta's trading at the top of its Bollinger Band, the first level of support that I see for Meta is at the middle of this Bollinger Band, which is the $625 strike price. So let's pull up the options chain and see what kind of premium we can collect. Again, I'm going to go out to the January 9th, 2026 options chain. And if you look at the 625 strike price, this is a delta of 20, and we have about a 1.1% return on our capital, which is not the greatest. And keep in mind, if you sell one cash secured put at the $625 level, then it would require $62,500 in collateral, which is obviously a pretty solid chunk of change for any size of account. So keeping that in mind, instead of selling a cash secured put, we can actually sell a put credit spread, which would only require a fraction of capital compared to selling a cash secured put on Meta. What I would like to do is actually go a little safer, and I'm going to go down to the 615 strike price. And in this case, we would open a put credit spread by selling the 615 strike price put option, and then we would simultaneously buy back the 605 put option. And in that case, we have a $10 wide spread, meaning that it would require only $1,000 to open up this spread. And as you can see, going with this spread, you would collect a premium of $1.35, which if you multiply that by 100, that would be $135 that you would collect by only putting up $1,000 in collateral. And that would be a 13.5% return on your capital in just about 30 days. So let's talk about what happens at expiration. If at expiration, Meta continues to trade over our short put strike price, which is 615, we get to keep 100% of the premium that we collected at the time that we opened our position. However, if Meta starts to trend downwards, getting closer to the 616 strike price, at that point, you probably want to exit your position because you don't want to take your max loss. Instead, you want to exit the trade at a smaller loss and potentially re-enter at a better time. My final pick for this video is SoFi Technologies. And if we look at SoFi's chart over the past few days, SoFi has been gapping down, and let's check out why. So last week, SoFi made an announcement that it's going to issue 1.5 billion worth of public stock offering, selling about 54.5 million shares at $27.50 each to raise capital for general corporate needs, strengthening capital, future growth, including tech investment and new ventures like crypto. Obviously, that announcement caused SoFi's price to drop, just as we saw on the chart, as investors see large stock sales as a negative event, fearing dilution and signaling weakness. Now, I certainly believe that we can see a short-term downtrend in the SoFi stock. However, in the long term, I'm still bullish, as SoFi is one kind of a bank and the only chartered bank to have crypto and a one-stop shop for the younger generation, has 12 million members, and continues to innovate and add new products. So I consider this as an opportunity to continue building my position into SoFi. So looking at SoFi right now and where it's trading, it's slightly underneath the middle of the Bollinger Band. If I look at support levels, I see a strong level of support here at the $25 level. It came down to the $25 level back in October and then jumped back up. And then it touched the $25 level back in November, on November the 7th, and then jumped back up. And then towards the end of November, again, it came down to this $25 level. And while it slightly jumped out of the Bollinger Band, it quickly jumped back up and then it came back down. So I see the $25 level as a strong level of support. So let's pull up the options chain and I'm going to go out 32 days. Now, if you look at the $25 strike price going 32 days out, that is a delta of 26. So while the 26 delta is slightly aggressive, I do like SoFi and I wouldn't mind taking an assignment at the $25 level. Also keep in mind that if you sell cash secured puts at the $25 strike price, you would collect a premium of $81. And then for this, you would only have to put up a collateral of $2,500. So that's great for small accounts or if you're looking to build a new position into SoFi. Also, if you look at the return on capital, then going with the $25 strike price, this is a 3.3% return on your capital, which is absolutely fantastic. I generally target a return of anywhere from 2 to 5% on my capital. So a 3% return or higher is generally pretty good in my opinion. Now, if you like to be a little safer, you can go down one strike price to the $24 strike price. And going with the $24 strike price, you would still make about a 2.2% return on your capital. So again, it depends on your risk profile and what you're comfortable with. If SoFi continues to trade over $25, the entire premium is for us to keep. And if SoFi does drop below $25, I'd be very happy to take assignment at the $25 strike price and ride SoFi all the way back to 32.73 and potentially even higher in the next year. Because if we end up getting interest rate cuts next year as anticipated, then that should certainly provide an additional boost to the SoFi stock. So that's it for this video. If you enjoyed it or learned anything useful, please be sure to give it a thumbs up, subscribe to my channel, and comment down below with your thoughts or questions. If you would like one-on-one coaching directly with me or be part of my Discord community, click on the first link in the description below and I'd love to help you out. I'll catch you in the next one.